Hello and welcome to the Mutual Fund Show. I'm Neeraj Shah. Over the next 25 minutes, we'll try and do three things. One, of course, take queries, and some of you have written to us, so we'll try and take the queries with our experts. We will try and give you insights on 2 or 3 key things. There are some interesting fund options, as they always are, but ones which have come up new, and we'll try and talk about some of those and what's the applicability of those fund options for you as an investor. This is happening on a day when the equity markets are doing really well. So joining us on the show today to give us the right advice are Vishal Dhawan, founder and CEO of Plan Ahead Wealth Advisors, with us in our studios, and Anant Ladha, founder of Invest Arch for Kal. Vishal and Anant, both of you, thank you so much for being with us on the show today.
Such a pleasure, Neeraj.
Yeah.
Thank you.
Thank you so much. The pleasure is entirely ours. Okay, let's start off with the first topic. There is a fund which the subscription of which just ended, but it's an open-ended scheme, and that's the Kotak Nifty AAA Bond June 2025 HTM Index Fund. Now, lest this confuse you. Effectively, it's a fund which will presumably invest in fixed income, and it assumes significance to my mind simply because of the various events that are lined up. Last night, viewers, you would have heard about the borrowing plan of the government for the first half, which is not as high as people thought, and which is why yields have come off today. Then there's the JP Morgan bond inclusion event that is happening in June this year. There is a Bloomberg bond index inclusion that is happening presumably in January of 2025. And there will be presumably some rate decisions done by both the global and the local central banks. So all of this keeps the fixed income calendar very active, and possibilities of making gains in fixed income very much high. And therefore, in light of this, I would love to understand from our experts, what kind of investor should invest in a fund like the Kotak Nifty AAA Bond Fund, and are there other options out there as well? Vishal, I'll start off with you. One, who should invest? What are the kind of returns that should be anticipated? And any tax implications for somebody who is in the highest tax bracket wanting to invest into this fund?
Yeah, so I think it's a great time for fixed income in general, I think for all the reasons that you mentioned, except that I think when you're a fixed income investor, you need to keep in mind 2 things. One is either you hold to maturity, which is a product of this kind from an ideal design perspective, saying, you know, in June 2025, this product will mature. And therefore, even though it's open-ended to go in, it will probably give back your money to you unless it's extended in June 25. So I think if you're an investor who's going to hold to maturity, I think some of the interest rates going down story may not really play out too much, because you will get the return that the YTM of that fund today has, less expenses broadly. However, if you are a tactical investor who's out there trying to figure out, can I take advantage of falling interest rates? You need to keep in mind that this has only a 1 year or little more sort of duration. Because it's got a fairly short duration, the impact of interest rate movement is going to be fairly small on the portfolio itself. So you may not see a lot of capital gains that could come in because interest rates come down. So in our mind, clearly there are 3 things investors need to keep in mind. One is, if you are a low tax rate investor, or you're someone who's very conservative holding to maturity, then this is definitely something you could consider. The rate of return you'll get is going to be whatever is the yield when you get into the fund, less expenses, give or take a little bit.
Which is
somewhere in the region of about 7.5% currently.
Pre-tax.
Pre-tax, that's right. And therefore, it's very attractive for someone who's in a tax bracket which is lower, because if you're in a higher tax bracket and you end up having a 1 year sort of investment horizon, then maybe you want to look at arbitrage funds more carefully, because the advantage that you get there clearly is that you get the ability to go out and get a tax rate which is lower. Even if you hold for less than 1 year, you'll get a 15% tax rate, which is equity taxation. If you hold for more than 1 year, you'll get 10%, which is obviously much more attractive. So clearly, if you're a high tax investor having a 1 year investment horizon, then you may want to think about whether you really want to put money in here, or you want to look at an arbitrage fund. But if you're a conservative low tax investor, I think this product could fit in there.
Okay, thanks for that insight. Anant, can I ask you the same question? And again, you know, from a tax implication perspective, and otherwise just the suitability of the product, what would your thoughts be?
So basically, they are investing in a AAA rated bonds of PSUs, HFCs, NBFCs, and banks. Totally, they are this index fund is invested or giving their money out to 23 parties. It is best suitable for someone who is looking out an investment option in fixed instrument for a comparatively short-term horizon and at a low cost and a relatively safer option, because this fund is investing or giving money to the parties which are AAA rated. So it is suitable for that kind of investor. As rightly mentioned, yield presently is roughly around 7.83% and modified duration is around 1.12 years. So roughly we can expect returns in the range of 7.5 to 8% maybe in a better situation. And taxability will be just like your fixed deposit. Just like your fixed deposit get added to your income, it will be added, and whatever rate is applicable to you as an individual, at the same rate, you will have to pay taxes on the income which you earn from this fund.
Got it. So, Vishal, are there better options currently? Or are there other options which people can look at? Sure, there is this fund. People might have thought of it, but are there other options out here?
Certainly, I think there are a couple of ways to think about it. One is arbitrage, like we discussed.
Right.
If you're looking at fixed income and trying to participate in rate cuts that are happening, then I think you need to look at two categories very carefully. One is the same category, but with duration which is a little longer. So you would look at a hold to maturity fund tracking in similar index, but the index maturity would be 28, 29, 30, 31.
Why so?
For example, because if interest rates do fall, and we don't know the timing of it, but that's probably the direction that interest rates are headed in, then you will get better capital appreciation because the modified duration of this portfolio, which is 1 year or 1.1 years in this particular fund, now gets expanded. So that's one way to do it, because it's again a low expense product. It allows you the ability to participate. The other way to do this is, if you want to participate purely in government securities, go and buy a constant maturity gilt fund. They will typically run durations which are in the region of about 6.5 years. Again, low cost, no fund manager risk, just like in these funds, because essentially you're just putting money away into government securities. Duration is also fixed. So you can participate in the same way through different ideas, depending on what your view on fixed income markets may be.
Okay, got it. Well, viewers, those are some options in case you look at. And again, one that maybe look at a higher or products which are not maturing, or the fund is not giving the money back to you in such a short span of time, but maybe the time frame is about 3 or 4 years out. Also, the benefits of indexation if you invest in fixed income funds, got to keep that in mind on other products as well as maybe this one. So that's the other aspect to keep in mind. And 3, if you're investing for a very short time frame, then maybe arbitrage funds might be better, because the tax implications, especially if you're in the higher tax bracket, might be very, very pertinent. So that's to be kept in mind. Sorry, Anant, just before we round off this piece, is there any other point that you would want to make? Because I was asking Vishal about options. Are there other options to your mind?
See, if an investor has time horizon of above 3 years, probably all season bond fund can also be an interesting space where he can look out for some opportunities, because then you will be giving your money to the fund manager and he'll be taking call of duration on your behalf. So that can be an interesting space to watch out.
It's just the perfect day to talk about high beta funds, isn't it? Because the issue came to mind because Motilal Oswal, for example, has launched a Nifty Realty ETF and a Nifty Small Cap 250 ETF. Now, typically these are high beta indices per se. They move a lot at any point of time on the upside or the downside, and therefore on a day when the markets are doing so well, it's great to try and figure out whether these are good indices, ETFs to invest into or no. Anant, I would love to understand from you what kind of investors within your investor subset would you recommend a realty ETF or a small cap 250 ETF?
See, firstly, if I talk about small cap 250 ETF, I feel for an aggressive investor who is having time horizon of 7 years plus, still it makes sense. I have 2 interesting data points to share with you. Firstly, in recent past, obviously small caps have performed brilliantly, but at the same time, EPS growth rate have been fabulous in small cap space. In last 1 year, EPS has grown by almost 62% versus in Nifty EPS has grown by 30%. So we can conclude that yes, in small cap space, there has been some beautiful rally which has come, but at the same time, EPS has grown. And second interesting data is in 2023, if we check out the number of down days of small cap index, number of down days was just 76. And in past 20 years data, whenever the down days is less than 85, in the coming year, we usually see more of volatility. On an average, small cap give a correction of around 20%, 22% every year. But whenever there is low number of down days in a particular year, in the subsequent year, usually the volatility or the correction even goes up to 30-32%. So keeping that in mind, we can get some opportunities in this year in small cap space. So doing SIP is a brilliant way for an aggressive investor to go about it. Plus, even if you get some dip, you should be ready to double up your SIP for that particular month whenever you get that opportunity. So small cap space is interesting, provided your time horizon is above 6-7 years. If we talk about reality space, that is something which I usually try and avoid for investors, because that's taking a tactical call or a sectorial call. Although in past 5 years, 3 years, reality sector has outperformed Nifty. But if we talk about 15 years, reality has been underperforming. So right now, everyone is thinking that since India is growing, government is doing a huge amount of capital and capital expenditure. So obviously this sector can do well. But I would personally say for a newbie or a new investor, this can be probably avoided and can be used at a later stage when he's more matured in terms of volatility which comes in this fund.
Okay, fair point. And you can understand that as well. But for people who are willing to take a bit of risk, Vishal, real estate, typically the cycles are longer. Would a realty ETF be a good way to play that? Or you reckon people might be doing better with individual stocks instead of taking an ETF like realty ETFs? So when it comes to funds or ETFs, rather not choose this. What's your thought?
So I think the way to think about this is stocks are always forward discounting mechanisms. So clearly, I think a lot of the growth that we are seeing on real estate is getting priced into markets in advance. It always happens 6 months, 12 months in advance. And clearly, if you look at valuation data, because I think we are always slaves to valuation and earnings. I think the way we look at it is earnings look good, but valuations are one standard deviation above mean for real estate companies. And therefore, I think even for very aggressive investors, they want to be very mindful that if they're buying today, they may be buying something which is very expensive already. And therefore, what you end up doing when you buy something very expensive is you end up getting probably muted returns because a lot of that has already played out. Now, if that, even if you're aggressive, I think the question to answer is, are you better off buying something which is a little more diversified rather than just a narrow sectoral bet? So let's say, for example, you want to participate in the growth story, which will play out in different ways, not just through real estate. I think you may decide to buy a thematic fund to participate rather than just say, let me go to a real estate ETF to participate.
But real estate would be thematic as well. So what?
So I think the difference is that a broader theme versus a sectoral fund, which is what is the difference.
Like
so
infrastructure or cap
yeah,
goods
that's
or
a
what
much
have you.
so that has much more flexibility, because what we can find is these cycles can change very quickly. And I think most investors, even if they are aggressive, don't necessarily have the ability to time the in and the out. So it's partly that as well, which needs to come into play.
Okay, just one quick follow-up. The small cap 250 ETF, I mean, what about that? Because small caps are the future, if you will, and if you're buying an ETF, you're buying it at a lower cost. So is that a good option, or you rather avoid it?
So again, valuations are very, very premium. And I think if you look at past data, I think one of the ways to look at this is you look at what is your rolling return over 1 to 3 years, which means on an average, how much do these funds deliver or ETFs deliver versus what they've actually delivered over the last 1 and 3 years. You'll see a very large gap. They've done much higher returns in the last 1 and 3 years over their rolling outcomes. And normally when you see this kind of data, it's time to be careful. It's time to moderate your expectations. It's time to be very mindful that maybe you're just buying something too expensive again. And unfortunately, our belief right now is that a lot of small cap investors may not end up making money for a fairly long period of time just because they're buying something so expensive. SEBI has also come out and spoken about this fraud. AMFI's come out with guidelines. I mean, all of that has also happened. So I think we should not discount that entire reality as well, which is playing out.
Okay, viewers, there you have the answer. Well, almost both the guests unequivocally talking about avoiding for different reasons, or maybe in some sense overlapping reasons, at least on the real estate ETF or a realty fund, if you will. Just be careful, know your ins and outs and the pros and cons of doing this before you go out and do this. Now, let's take some queries. There are a bunch of queries that have come in. The first one, if I'm not wrong, is from a gentleman called Rabilal. Now, Rabilal Chetri. Mr. Chetri is aged 35 years. The goal is high returns. So I think that's clear. And Anant, I'm starting off this with you. So just hear me out. Mr. Chetri is seeking high returns and is saying that he's investing 10,000 rupees per month in the SBI Energy Opportunities Fund, a direct growth option. He wants to know if it is the right fund or should he diversify the portfolio?
I feel investing complete amount in a single thematic based fund can be a bit risky. He can, if he's an aggressive investor, probably he can look at a space like small cap fund or maybe a multi cap fund. Provided his time horizon is also more than 5 years, that can give him a more stabilized return over the longer period of time. Usually what we do is, especially when we are chasing returns, we forget about risk. But eventually, if you want to stay in this game for long term, you should even focus on risk because that will define how you will react during difficult times. You don't make money in good times. You actually make money when times are bad, but you have conviction to invest during that time. To have that conviction, you need not, you just need to ensure that you are not making a big blunder. So my take would be to go with a small cap fund. And this year, as we have already discussed, we might get some volatility, which will be more than usual. But that volatility might even bring some opportunities to top up your investment and probably aim at a better return over 5 to 7 year time horizon. So that can be a more comfortable way to go about it.
Vishal, your views?
So I think I mirror most of those views that, clearly taking a bet as on one single theme and assuming that that's going to be the best outcome in the end of 5 years is probably too risky. I think, these things can change pretty quickly. And we know that energy itself is going through so much of transition from traditional sources to renewables to geopolitics that impacts it. So I think there are so many factors at play there that even if you have return expectations that are high, you could see so much volatility that along the way you could become uncomfortable and just exit.
Okay, fair call. So, Mr. Chetri, if this is the only investment that you have, then maybe you should rethink it. If this is one of the many that you have, which we don't know of, then it's a separate argument. But right now, we've given you the answer. I believe the guests have given you the answer on the back of the belief that this is the one investment that you have, and therefore, diversification might actually serve you better in risk-adjusted returns. And frankly, returns should always be viewed from a perspective of risk-adjusted returns as opposed to just plain vanilla returns. Even on that, I think the guests might differ, but here's the simple submission. Now, the second query is from Deepak. Deepak is 32 years of age. The goal is child's education. Deepak says, I'm investing in the Mirae Asset large cap, mid cap funds, along with a few others, which we don't know the names of, but yeah, along with a few others. Deepak says that they have been underperforming for the last 2 years. Should he book profits or switch to another fund? His current SIPs also include a Kotak Emerging Equity Fund, a Nippon India Multi-Cap Fund, and SBI Contra Fund, amongst the others, like the two Mirae funds. Vishal, any thoughts?
So I think very clearly, we are assuming that education at 32 for him or his child is a very, very large time horizon story, and he has enough time on his side. Now, I think it's important to distinguish performance basis a style versus a different style. So clearly over the last couple of years, value style oriented funds have actually outperformed growth style funds. And Mirae, in general, has always been a growth style fund, which is why it did so spectacularly well just a few years ago, because it followed that style. And it's been true to its style, so it's continued to be that way. Obviously, what it means is during certain periods, you will outperform, in another period, you will underperform. I think for someone who's a long-term investor, I don't think you need to necessarily make changes every couple of years because the style that you were using has now gone out of favor. We would assume it will come back as well. I think the more important thing to think about here is with the excess premium valuations on mid-caps as well. There are two mid-cap funds clearly in that portfolio, both from Mirae as well as from Kotak. The question to answer here is that do I really have that sort of appetite? Or have I had a little bit of a recency bias that I might be chasing some past returns? And I think that's where the decision would probably be that one of those funds, maybe a Kotak Emerging, might actually go out of the portfolio. There have also been some management changes, etc., that have happened in the fund. But besides that, I think you need to pare down a little bit of mid-cap exposure in this portfolio. And clearly, as you get closer to the requirement of money, I'd say at least 3 years before you require the money, there is a need to pare down that risk even further. You need to start moving to more sort of fixed income oriented instruments because we don't want education to be compromised. And clearly, an education goal is a very time critical goal. It's not like you can tell your child that, go to college next year because markets are down this year.
Yeah.
So I think some of that clearly needs to come into play.
Okay, fair point. Anant, does your view differ?
Sync with his view, completely in sync. Just would like to add one extra thought. See, as a mutual fund investor, we always want to do something with our portfolio. And we need to understand that not doing anything is also a decision which you are taking with your portfolio. And that's a most difficult decision to do. So at times we need to just wait and give your fund manager at least 4 to 5 years of time and then decide whether we need to change it or we need to switch it or maybe move out and go to another fund. But at least give some time to your fund manager to perform as well.
And Deepak, that might be good advice, though you might argue that you've seen returns in the past and the last two you are not, but it's in the same vein, as Vishal was saying, at some point of time, these returns might come back. And if you've just started investing, then what Anant just said, that give your fund manager some time to invest, would hold completely true. So depending on when you've started as well, you could follow the advice. But I think the advice is in some sense very similar. So keep that in mind. Maybe no changes required to your portfolios. It's a long-term goal, child's education. Stay the course as opposed to deviating might be a good advice. But on that note, we'll have to wrap it up because we had timed out completely on this leg of the mutual fund show. Anant, Ladha, Vishal, Dhawan, thank you so much, both of you, for taking the time out and being with us. And viewers, thanks for tuning into this leg of the mutual fund show.